after effects of the failure of Silicon Valley Bank, the closure of Signature Bank, and what was, in effect, a full-blown run on Credit Suisse will no doubt be felt for some time to come. Depositors are now nervous and also aware of how they can perhaps get high yields on government bonds relative to the yield they can get on cash in the bank. Banks are nervous about how depositors could withdraw assets and therefore have to manage their loan books accordingly by either slowing or halting loan growth, especially as trust, that most precious commodity, is now at a premium once more. And investors are nervous as they assess whether central bankers can manage inflation and growth on one hand and financial stability on the other, all while using the blunt club of an instrument that is monetary policy. Lest it be forgotten, it takes around 18 to 24 months for the effect of interest rate rises or decreases to filter through, and in the UK, that means for the rises from this summer onwards. Companies will be watching all of this as well. Although it's too early as yet for them to feel the effects of any effects of the banking wobble, they'll be providing commentary on the effects of inflation and increases in the cost of money. So the latest weekly round of corporate updates should be as informative as ever. A good number of large, mid and small cap firms are due to report, and names which may be worthy of further attention and research include the following, although again some of these dates could yet be subject to change. Essential and Beaver Group on Monday the 27th of March, United Utilities, Ocado, Wood Group, AG Bar, Bellway, S&U and Petershill Partners on the 28th, Michelmersh Brick, Strix, IQE and Central Asia Metals on the 29th, Moonpig on the 30th, and Vanquis Banking, Mears and James Halstead will close out the week, the month and the quarter on Friday the 31st. But the company which could just cause the biggest fuss in the week ahead is Next. The FTSE 100 member and multi-channel retailer is scheduled to release its full-year results at the end of January on Wednesday the 29th of March. Now the shares are almost unchanged from a year ago, helped by a big rally from the autumn lows. That's been stoked by hopes the UK will dodge a recession, that inflation would cool, and the Bank of England will be able to cut interest rates, although Next's Christmas trading update in January has helped as well. Chief Executive Lord Simon Wolfson and the company confounded bears of the stock by upgrading sales and profit forecasts for the year, albeit after a downgrade back in the summer. These full-year results will be benchmarked against the forecast made in that trading update, while analysts and shareholders will also look out for any guidance from Lord Wolfson for the year to January 2024, and they'll compare that with current consensus forecasts as well as the year that's just finished. So the first number to look at will be revenues, and after an unexpectedly strong Christmas, with full price sales up 4.7% in the 9 months to the 30th of December, Next steered analysts to full price sales growth of 6.9% for the full year to January. On a headline basis, the consensus forecast is for £5.1 billion of sales, a 4.5% increase. For fiscal 2024, Next has guided to a 1.5% drop in full price sales, when analysts are looking for almost unchanged headline group revenues, again at $5.1 billion. Analysts will then look to the sales mix. In the third quarter, online full price sales fell 1.9% year on year, retail grew by 3.1%, and financing interest income by 8.9%. Higher rates will have helped income in the last named, or it'll be interesting to see if the company flags any increase in bad debts if shoppers are having to rely more heavily on credit to make their purchases. Hopefully wage growth means the answer to that is no. Then attention will turn to pre-tax profit, where Next nudged up its guidance by £20 million to £860 million, a 5% increase on last year's £822 million. For fiscal 2024, management has steered estimates to an 8% drop in pre-tax income to £795 million, thanks in the main to cost increases of over £100 million relating to wages and utility bills in particular. Finally, Lord Wolfson has suggested that earnings per share, or EPS, would rise 7% to 569p for the year just ended, before a 12% drop to 501p in 2024, the year just begun. This drop is due to the increase in UK corporation tax, partially offset by a potential £220 million share buyback as a result of as a return of what the company terms surplus cash. Now, those buybacks reduce the share count and therefore increase the profit per share. In the first half of the year to January 2023, Next had already spent £228 million on them. Shareholders will then look to the dividend. Analysts are looking for a final payment of around 129 pence a share to take the full year total to 195p, and that follows the 66p a share interim. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to talking to you again next week.